The stock market is in a constant state of flux, with major indices bouncing between explosive gains and cautious retreats in recent weeks. This unpredictable rhythm, fueled by a mix of Federal Reserve policy shifts, critical economic updates, and corporate financial reports, has left investors in a state of high alert, eagerly waiting for the next big event that could shift the market's trajectory. Right now, the focus is on a period of intense volatility, with traders closely watching upcoming economic indicators and corporate performance, especially in the tech sector, which often leads the charge. But here's where it gets controversial. While the market has been driven by optimism about potential interest rate cuts, many experts warn that this euphoria may not last. The recent surge in the Dow Jones Industrial Average, DJIA, SP 500, SPX, and Nasdaq Composite, IXIC, was partly fueled by dovish statements from Fed Chair Jerome Powell at the Jackson Hole Symposium, suggesting the central bank might ease its monetary policies. On August 22, 2025, the DJIA hit a new record high after rising over 800 points. While the SP 500 climbed 1% following Powell's speech and gained 25% since its April 8th low, the Nasdaq, meanwhile, soared 38% since April 7th, fueled by the Liberation Day tariffs announcement. However, this upward momentum was short-lived. On August 25th, the market pulled back as investors took a step back, digesting the rapid gains and waiting for more clues. The DJIA dropped 234 points, 0.5%. By midday and fell 350 points, 0.77% after its record high, while the SP 500 dipped 0.43% and the Nasdaq closed slightly lower, though tech giants helped cushion the blow. Earlier in the week, the DJIA faced another setback when Home Depot missed earnings expectations, highlighting how even broad market rallies can be derailed by individual company underperformance. This roller coaster ride has created a dynamic environment where certain sectors thrive while others struggle. The tech sector, for example, has benefited from the anticipation of rate cuts, as lower borrowing costs can fuel growth and increase the value of future earnings. Communication services and energy stocks also saw gains on August 25th, reflecting a shift in capital toward value plays beyond the usual tech heavyweights. Conversely, consumer staples and healthcare suffered the largest declines, as investors moved away from defensive stocks during uncertain times toward more aggressive growth assets. Companies like Home Depot, which missed earnings expectations, serve as a reminder that individual stock performance can be volatile even in a broadly rising market. Meanwhile, fears of an AI bubble have intensified, with some investors questioning whether the rapid rise of AI-related stocks is sustainable. The broader implications of this market movement go beyond individual stocks. The Federal Reserve's influence on market sentiment is undeniable. Every hint of a rate cut or hike sends shockwaves through the economy. This underscores the deep connection between monetary policy and market behavior, making the Fed's decisions a key factor in investment strategies. The AI bubble debate also reflects a larger trend of speculative investing in emerging technologies. While AI has immense potential, the sharp rise of some AI stocks has raised concerns about overvaluation, echoing past tech bubbles. Additionally, trade policies like the Liberation Day tariffs highlight how geopolitical decisions can impact global supply chains, corporate profits, and investor confidence. These policies can lead to higher costs for businesses, potentially slowing consumer spending and economic growth. Looking ahead, the market's path will depend on several key factors. Short-term, traders will be watching the PCE price index and non-farm payrolls data, which are crucial for assessing inflation and employment trends. A surprise in these metrics could challenge the Fed's plans and trigger a market reversal. Meanwhile, Nvidia's earnings report on August 27th is a major focal point, as strong results could reinforce confidence in AI as a growth driver. In the long term, companies must adapt to shifting consumer habits and potential regulatory changes. Those that can navigate cooling demand and evolving trade policies will likely thrive, while firms with high debt or reliance on discretionary spending may face challenges. Investors should prepare for continued volatility as the market remains highly sensitive to economic data and central bank communications. At the end of the day, the stock market is at a crossroads, balancing the forces of monetary policy, economic reality, and technological innovation. The key takeaway is that the Fed's rate decisions have a profound impact on market sentiment, with every hint of a cut sparking rallies and every sign of persistent inflation triggering pullbacks. The coming months will test how effectively the economy manages inflation, how central banks adjust their policies, and how companies adapt to changing consumer behaviors and global dynamics. Whether this is a bullish opportunity or a cautionary tale will depend on how these forces play out, and we'll be watching closely.